For years, Americans were told a simple story. The United States was locked in an economic showdown with China, a trade war meant to protect jobs, punish unfair practices, and reclaim industrial power. Flags waved, tariffs rose, and headlines screamed conflict. But beneath the noise, something far more important was happening, almost unnoticed. While politicians fought on television, Wall Street moved quietly, deliberately, and at historic scale. Roughly $1.4 trillion flowed into China from America's most powerful financial institutions during the very years they warned the public about Chinese risk. That single contradiction should stop you cold. Why would BlackRock, JP Morgan, and Goldman Sachs bet massive sums on a country portrayed as an economic enemy? Why would financial elites do the opposite of what the public was encouraged to believe? This video is about that question, and why ignoring it can be costly. Because history shows a brutal truth. When narratives and capital flows diverge, capital is usually right. Those who follow slogans stay exposed. Those who follow money survive transitions. And right now, that gap between story and signal is widening again. Officially, the trade war was framed as economic self-defense. Tariffs were sold as tools to punish China, revive American manufacturing, and force fair trade. Night after night, viewers heard that supply chains would return home and that capital would follow patriotic incentives. The message was clear. China was toxic, risky, and increasingly cut off from the global financial system. But money told a different story. While cameras focused on tariff lists and diplomatic insults, investment channels stayed open. U.S. asset managers expanded operations in Shanghai. Banks applied for majority ownership of Chinese securities firms. Index providers quietly increased China's weighting in global portfolios. Capital didn't retreat, it accelerated. This is the first lesson serious investors learn. Policy theater and financial reality rarely move in sync. Markets don't respond to speeches. They respond to incentives, access, and long-term positioning. Behind closed doors, Wall Street saw something the public conversation ignored. China was opening financial markets at the same moment America was politicizing its own. Data confirms the divergence. Cross-border portfolio flows surged. Private equity, bonds, and equities poured into Chinese markets through approved channels. Even as tariffs climbed, balance sheets leaned east. The trade war didn't freeze capital. It redirected attention while deals were finalized quietly. That gap between words and flows is where fortunes are made or lost, and it sets the stage for understanding how capital behaves when political pressure collides with historical economic cycles again today, with consequences few anticipate or escape unprepared. To understand why $1.4 trillion moved into China, you have to zoom out far beyond Trump, tariffs, or even the modern United States. This behavior is not new. It is ancient. Whenever an empire enters a period of stress, rising debt, internal division, external rivalry, capital begins to behave differently than politics. Elites adapt early, quietly, and rationally, long before decline becomes obvious to the public. In the late Roman Empire, wealthy families didn't wait for collapse. As taxation intensified and political instability spread, they shifted land, gold, and influence away from Rome and into safer provincial holdings. The rhetoric of Roman strength remained, but capital no longer believed it. The same pattern repeated centuries later as Dutch financial elites anticipated Britain's rise, and again when British capital flowed into American railroads, factories, and debt before the British Empire officially ceded dominance. In each case, the public narrative lagged reality. Citizens were told their empire was strong, their institutions permanent, their currency sound. Meanwhile, those closest to power-hedged exposure, they diversified geographically, they prioritized growth over loyalty, they positioned themselves for the next system before the current one visibly cracked. This is not betrayal, it is pattern recognition. Capital is not patriotic, it is adaptive. It senses structural stress earlier because it responds to incentives faster than political systems can reform themselves. When regulation tightens, growth slows, and debt expands, capital looks outward for opportunity and stability. That is the historical lens Wall Street operates through, whether it admits it publicly or not. From Rome to Britain to America, the cycle repeats with uncomfortable consistency. Capital moves first. Power follows later. By the time decline is obvious, repositioning is already complete. Seen through this lens, the China bet looks less shocking and more familiar. It wasn't a sudden gamble. It was the latest chapter in a long, well-documented cycle, one that quietly rewards those who understand history and punishes those who mistake permanence for reality. To understand why Wall Street moved toward China, you have to understand how Wall Street actually works, not how it's portrayed, but how it's built. Institutions like BlackRock, JP Morgan, and Goldman Sachs are not ideological actors. They are machines designed to manage risk, maximize returns, and survive across political cycles. Loyalty to any single nation is secondary to fiduciary duty and long-term positioning. Asset managers are judged quarterly, but they think in decades. Their models don't ask whether a country is popular. They ask whether capital will grow, whether markets will expand, and whether access can be secured before competitors arrive. From that perspective, the late 2010s presented a clear asymmetry. The United States offered slowing growth, rising political polarization, and aggressive monetary expansion. China offered scale, industrial momentum, and a government actively inviting foreign capital into previously closed sectors. This is where public misunderstanding is greatest. Many assume Wall Street moves emotionally or politically. In reality, it moves probabilistically. It hedges, it diversifies, it prepares for multiple futures at once. When U.S. politics became louder and less predictable, China appeared comparatively stable, not free, not transparent, but structured and intentional. Regulatory openings mattered. For the first time, U.S. banks could own majority stakes in Chinese securities firms. Asset managers gained access to domestic bond markets. Index inclusion guaranteed forced inflows from global funds. These weren't ideological choices. They were structural incentives. From Wall Street's perspective, not moving into China would have been reckless. Competitors would gain exposure. Clients would demand returns. Global benchmarks would rebalance with or without patriotic considerations. Survival in finance requires anticipation, not alignment. This is the uncomfortable truth. When systems strain, financial elites don't wait for clarity or consensus. They act under uncertainty, guided by incentives, history, and asymmetrical opportunity. And by the time those moves become visible, the advantage is already gone. To outsiders, China looked dangerous. State control, opaque regulation, and geopolitical tension dominated headlines. But to institutional capital, China presented something far more valuable than ideological comfort: a controlled environment with enormous upside. Wall Street understood that risk is not eliminated by freedom. It is managed by structure. And China offered structure at scale. Beijing wasn't asking foreign investors to trust democracy, it was offering access. Carefully negotiated entry points into equities, bonds, and asset management came with clear rules, long timelines, and implicit state backing. For global institutions, this mattered more than rhetoric. A market doesn't need to be free to be profitable. It needs to be predictable. China's centralized planning created a form of stability that Western democracies, increasingly paralyzed by political swings, struggled to maintain. The growth differential was impossible to ignore. While U.S. growth slowed under debt and demographic pressure, China continued expanding industrial output, urbanization, and consumer markets. Entire sectors, technology supply chains, green energy, infrastructure finance, were growing at speeds unavailable in developed Western economies. For capital managers, ignoring that trajectory meant underperforming peers and benchmarks. Critically, China didn't open its markets out of generosity. It did so strategically. Foreign capital brought legitimacy, liquidity, and global integration. In exchange, investors accepted constraints, surveillance, and partnership requirements. To Wall Street, this was not exploitation. It was a trade, and the terms were acceptable. This is where public narratives collapse. Ordinary investors are taught to fear control and celebrate freedom. Institutional investors evaluate outcomes. They understood that China's risks were visible and managed, while America's risks, political paralysis, monetary debasement, and regulatory unpredictability, were growing less measurable. In that comparison, China wasn't the reckless choice. It was the calculated one. And when capital must choose between ideological comfort and mathematical advantage, history shows which side usually wins. To the public, the trade war felt confrontational and decisive. Tariffs were framed as weapons, negotiations as battles, and every escalation as proof that globalization was being rolled back. The conflict appeared binary: America versus China, winners and losers clearly defined. But in financial reality, the trade war functioned less like a blockade and more like theater. Political conflict creates noise, and noise creates opportunity. While attention was fixed on headlines, capital quietly repositioned. Tariffs reshaped supply chains but didn't sever financial access. In fact, volatility created entry points. Depressed valuations, forced rebalancing, and regulatory openings allowed long-term investors to secure positions under the cover of public hostility. This dual-track system served multiple interests. Politicians delivered visible confrontation to domestic audiences. Corporations negotiated exemptions and adapted logistics. Financial institutions expanded quietly, shielded from scrutiny by the very rhetoric meant to appear tough. The result was not decoupling, but selective insulation. manufacturing stress for optics, financial integration for returns. History offers parallels. During Cold War tensions, American capital still found paths into strategic regions through intermediaries and legal frameworks. Public conflict did not stop private positioning. It delayed scrutiny while deals matured. The trade war followed that script. It gave voters a story of resistance while giving sophisticated investors time to prepare for long-term shifts. By the time the rhetoric softened, the groundwork was already laid. Capital had moved, access had been secured, and the public debate had missed the point entirely. This is why focusing on political drama is dangerous for investors. The most consequential decisions are rarely debated openly. They happen quietly, legally, and far from the spotlight, while attention is carefully directed elsewhere. While Wall Street was quietly repositioning, most retail investors were doing exactly what they were encouraged to do: stay home, stay loyal, stay invested in familiar markets. The message was reassuring. America was strong, China was risky, long-term investors didn't need to worry. But that reassurance came at a price. Pensions, retirement accounts, and index funds remained heavily concentrated in U.S. assets, just as monetary expansion accelerated. Trillions were injected into the system, inflating asset prices while quietly eroding purchasing power. Inflation wasn't an accident. It was the tax paid by those without mobility. Meanwhile, institutions diversified globally, hedging currency risk and accessing growth unavailable at home. This is the structural disadvantage most investors never see. Retail capital is reactive. Institutional capital is anticipatory. By the time trends become safe to discuss publicly, the positioning phase is already over. China's inclusion in global indices forced passive funds to buy after prices adjusted, not before. The upside was captured early. The risk was socialized later. Ask yourself an uncomfortable question. Were your investments positioned where growth was happening or where narratives felt comfortable? Because comfort rarely compounds. Those who followed headlines absorbed volatility, inflation, and policy risk. Those who followed flows absorbed opportunity. This is not about blaming individuals. The system is designed this way. Information is asymmetric, access is tiered, and timing favors scale, but awareness changes outcomes. Understanding how elite capital moves doesn't guarantee protection, but ignoring it guarantees exposure. The real cost wasn't missing China's rise. It was trusting that public narratives would align with financial reality. History suggests they almost never do. The most important lesson in this story isn't about China, it's about timing. Throughout history, capital has always moved before power visibly shifts. Long before flags are lowered or currencies crack, money quietly changes direction. By the time the transition becomes obvious to the public, the advantage has already been claimed. This is how empires actually decline, not with a single collapse, but through gradual loss of confidence among those closest to the system. Elites don't wait for confirmation. They don't need consensus. They respond to incentives deteriorating at the margins: rising debt burdens, political paralysis, weaponized currencies, and declining returns on capital. These pressures don't make headlines at first, but they show up immediately in balance sheets. That is why the $1.4 trillion move matters. It wasn't a referendum on America's collapse or China's dominance. It was a hedge against uncertainty, a signal that the post-Cold War financial order, anchored unquestioningly to U.S. markets, was no longer the only game worth playing. Capital sensed increasing fragility at the center and optionality at the periphery. This pattern repeats relentlessly. Spanish silver flowed elsewhere before Spain lost supremacy. British capital favored America decades before Britain surrendered reserve currency status. Each time, the public believed stability would persist. Each time, capital quietly disagreed. Today's environment fits the template uncomfortably well. Debt levels are unprecedented. Political trust is fractured. Monetary policy is increasingly experimental. None of this guarantees imminent collapse, but it does explain why sophisticated capital seeks flexibility, diversification, and exposure beyond a single system. The danger for ordinary investors isn't that change is coming. It's assuming that change will announce itself politely. It never does. It reveals itself first through flows, positioning, and silent reallocation. Those signals are easy to ignore, until ignoring them becomes expensive. This is the real warning behind Wall Street's China bet. Not that America is finished, but that the era of unquestioned dominance is being quietly priced in. And capital, as always, is moving accordingly. The $1.4 trillion bet on China wasn't a headline mistake or an act of disloyalty. It was a signal that those closest to capital flows are preparing for a world that looks different from the one described on television. History makes one point painfully clear. When narratives grow louder, signals grow quieter, and more important. This story was never about choosing sides between nations. It was about understanding how wealth behaves when systems strain. Capital doesn't wait for permission, and it doesn't ask for consensus. It moves early, legally, and often invisibly. By the time the public debate catches up, positioning is already complete. For viewers, the lesson is not panic, it's perspective. Stop measuring reality by political rhetoric. Start watching incentives, flows, and structural change. Ask where growth is encouraged, where risk is quietly transferred, and where confidence is silently eroding. These questions matter far more than slogans. If this framework feels unsettling, it should. Comfort is expensive in transitional periods. Awareness is not. This channel exists to map those transitions before they become obvious and before the cost of ignorance rises again. If you want to understand what happens after capital finishes repositioning, what breaks, what inflates, and who absorbs the shock, subscribe. The next phase of the cycle is already underway.